morning, ladies and gentlemen. A very warm welcome to you on Business Today Television. I'm your host, Shailendra Bhatnagar, and we are in the 7th month of 2025. The index Nifty in a sideways band over the last 1 week or so after hitting a 9-month high. And at this point of time, we are at the cusp of first quarter earnings, which are likely to drive sentiment on the Wall Street. Lots of major events have lapsed in the last 3 months, and the index itself, from a low of about 21,740 in early March, has traveled more than 3,900 points to give a stunning 4-month rally. We are at crossroads. We are at a juncture where the index and the broader markets are searching for clues where to move in, and this is where our guest for today, Mr. Harish Bihani, Senior Fund Manager at Kotak Mahindra AMC, comes in. Mr. Bihani has been with Kotak AMC for the last 2.5 years, and before that he's worked with the ICICI Prudential AMC. A very good morning to you, Mr. Bihani, and a very warm welcome on Business Today. Paint for us a picture of sentiment on the Wall Street. How do you see markets in terms of valuations at 9 months highs?
Sure. Good morning, Shailendra. As you rightly pointing out, market has moved up fairly sharply in the past few months. Market is buoyant, looking at not necessarily the near-term numbers, but the changes that have taken place from a macro construct, especially with regard to India. First is when you think about government spending last year, it was on the lower side, and market is clearly presuming at this point in time that the government spending should inch up substantially over the coming months. Second is that the RBI policy that was fairly tight last year, we have seen a significant easing of the policy over the past 6 months. And as we all understand that finally money flow leads to better growth, better job creation, and higher money flow through the economy should ideally lead to an improvement in the overall sentiments and overall construct of growth in the coming few months and years to go. So that is what market is factoring as we speak.
Okay, fair point. Mr. Bihani is also the man behind the stellar success of Kotak Small Cap Fund, which we will be discussing in a while. But let's get his take on how overvaluation and underrepresentation of momentum in the market is working. Given the fact that, Harish, we are at 9 months high, and a lot of sectors such as defense have got into a very, very strong momentum because of individual reasons with Pakistan, the global war that's happening in Ukraine, as also Israel, Iran, and the US imbroglio. At this stage, do you think defense is an untouchable, or does it still provide value for long-term shareholders?
Sure. Again, defense has given fabulous return in the past few months, and valuations looks on the higher side for sure. Nonetheless, what the world has clearly told us, especially in the last few years, is that every country needs to inch up its defense spending and needs to be much more self-sufficient in terms of everything, including defense. So the overall defense spending and the indigenization part will continue to inch up according to our understanding over the next 3, 5, 10 years to come. So the call that we are taking is not that, okay, there's a temporary overvaluation and we should sell everything. The question that we are asking ourselves is that which stocks, if it corrects by say 20% tomorrow, you will buy much more. So these are stocks not to be parted simply because there's going to be a temporary decline in the market or temporary decline in sentiment. Given the theme is there for not only for the next 1 year, but for the next 3, 5, 10 years. And this is happening across the world. So many more opportunities for exports will also come to our fray, especially with regard to small developing countries. So a lot of opportunities, a lot of development, a lot of significant changes happening in the sector, and many, many interesting opportunities are coming our way.
Okay. Harish, how are you viewing first quarter earnings from the lens of a fund manager? where do you think will be outperformance, and how do you classify growth at this stage as far as EPS is concerned? What kind of EPS growth are you looking at sequentially, if at all, and of course year on year on the Nifty?
Sure. So first quarter, Shailendra will be a bit wobbly in our understanding, and reason is fairly simple. A sharp interest rate cut leads to an impact on the NIMs of banks. So they will see some pressure in the first 6 months of the year, and then it should start improving. IT sector should also have a slower start. Hopefully, things should start improving from the second half of this particular year. And there are some specific other sectors which will also see slower start. But two main components of, say, a Nifty is going to see a slower start. What we are expecting is this, that we'll start seeing an improvement not only in the index stocks, but also in the mid and small cap basket starting the second quarter onwards. Many reasons for that. And with that, a bit wobbly start first quarter single digit earning growth, which should start moving to a double digit earning growth starting the second quarter of this particular year.
Okay. Should viewers understand that you are a little more bullish on small caps and mid caps in the second half of calendar 2025 and maybe a little later in 2026 as well?
No, absolutely. I think small cap, the way we are looking at small cap sectors and companies is this, that as India absolute GDP increases from a 4 trillion to a 10 trillion over the next 12 to 15 years, there'll be a significant profit pool that will be created. And which companies within the small cap universe can capture a significant part of that profit pool, can grow disproportionate versus the overall GDP and the overall market. And India is a land of opportunity. Our entrepreneurs are working hard. They are looking to capture more market share. So can we identify those 50, 70 names in our portfolio which can grow disproportionate versus the overall market? That is our entire focus. And despite temporary overvaluation, we can live through temporary overvaluation. We cannot live through lower growth. So as long as growth is high for the next 3, 5, 7, 10 years, things should be fine overall in the construct of small cap investing in particular.
Okay. You manage three funds, one of them being Kotak Small Cap, the other being the Business Cycle Fund, and the third one is the Pioneer Fund. What is the level of monthly SIP that is coming in? And in terms of ballpark, where is it getting invested? Just a broad thrust. Are you sector specific at this point of time, or are you buying stocks within the portfolio which are probably giving an opportunity because of lower cost or maybe a better potential? Are you averaging them up or down? What's the broad thought?
Sure. So for example, I'll just give you example of one fund and then to specify how we think about the overall construct. A business cycle fund, as the name suggests, ensures that we identify 5 or 6 sectors where we'll invest 85 to 90% of the portfolio. So the construct is this, that let's identify 5 to 6 sectors. Within that, today, when you look at the portfolio construct, we are significantly overweight the healthcare sector, significantly overweight the consumer discretionary part. We are increasing our weight towards the BFSI part. We have higher allocation toward the auto ancillary. So once you have identified these sectors which can do well over the next 3 to 5 years, then second level is to identify which companies will do well within those sectors. And once you do that, and which will do well is in simple construct, the earnings and cash flow growth should be in high double digit. We think that as long as we can do that as a consistent process over the rolling 3 to 5 years, we'll do well on average over time.
Fair point. So healthcare, of course, gets a lot of prominence in Harish's small cap portfolio, and this is what we are now going to discuss. Kotak Small Cap Fund. Ladies and gentlemen, I'd like to show you some very interesting data that we've collected on Kotak Small Cap Fund. This is a fairly sizable fund of 70,330 crores in terms of AUM. The net asset value for the direct route is somewhere like 314 rupees. And what is interesting is that in the last 10 years, a 10,000 rupee monthly SIP, which is a total of 12 lakh rupees, has surged to 37.89 lakh rupees, which is a compounding of almost 22% each year. By any measure, ladies and gentlemen, this is a phenomenal performance, and against the light that in the last 6 months, small caps have been suffering a bit of selling pressure. Be that as it may, a lot of data is right there in front of your screen, and more importantly, in the equity holdings, you will see a lot of hospital healthcare stocks dominating. The first two in terms of weightage are AsterDM, Krishna Institute of Medical Sciences. A little later, you will find Vijaya Diagnostics, and then, of course, MedPlus Health. Now, let's get Harish's view on the healthcare sector. In your opening remarks, Harish, you mentioned that healthcare is where a lot of money, fresh money, is going in. And in terms of even when you look at your sectoral allocation, healthcare is 20.1% in the fund versus the sector average of 11%. What makes you so bullish on healthcare?
Sure. So, to our mind, when we look at the healthcare sector, it's an evergreen sector, specifically with regard to the domestic facing companies. You look at hospital companies, diagnostic companies, domestic pharma names. These are companies, and if you look at the growth over the past 3, 5, 10 years, you look at these companies compounding in high double digits over an extended period. And we think that some of the characteristics which led to this consistent compounding over the past 3, 5, 10 years should continue incrementally. For example, the hospital sector and the diagnostic sector, there's a clear value migration at play. There are a lot of tier 2, tier 3, tier 4 hospital and diagnostic companies. As India evolves and as the overall evolution of any industry happens, a lot of these tier 2, tier 3, tier 4 will get either shut down or they will get merged with the larger entities. And that is what we have seen over the past few years. And that pace has increased significantly to our mind. So as long as we can find the right entrepreneur who's growth hungry, as long as we can find that not only is he growth hungry, but he understands value creation principles, and as long as he can understand these principles and he can ensure that he can do this consistently over the next 3, 5, 10, 15, 20 years, there's significant amount of money to be made in some of these companies. So that's the focus area, and we think that what's happened in the past is highly likely to play out in future too.
Okay, and that's the reason, ladies and gentlemen, none of the usual names that you see in the fund, which is across many funds, which are banks, which are private sector NBFCs, find their presence in Harish's small cap portfolio. It's an extremely unusual kind of a fund which I have analyzed after many months, and perhaps that's the secret sauce why you see such stunning returns coming in. In the last 3 years or so, the fund has given a even higher CAGR, which is 22.5%. So 3 years, 22.5%. 10 years, it's 21.79, and since inception, it's 17.5. If you look at the top 10 stocks, they occupy about 28% of AUM, top 5 are about 16%, and top 3 sectors are 43.5% of total AUM. Harish, when you go hunting for value or when you go hunting for growth, what are the 2 or 3 things that you look into a company before pressing the buy button?
First of all, when we are looking at any company, the first question that we ask ourselves is this company solving an important customer problem? If the company is solving an important customer problem and it's run by a owner operator, which is growth hungry, then all else being equal, things should be fine. And how do we measure that is this solving an important customer problem and run by a phenomenal entrepreneur is to look at market share gain data. And market share gain data clearly tells us that things are moving in the right or wrong direction. And lastly, we look at the value creation principle, which is return on invested capital higher than cost of capital. If that can happen sustainably with all the other that we have spoken about, then a temporary overvaluation, undervaluation will not matter much to us because we are looking at a time horizon of 5 to 10 years. So these are some of the parameters that we look at when we are hunting for any small cap idea.
Okay, you seem to have hit a winning button when it comes to healthcare. The other broader theme that I see is industrials, which are about 22% of fund AUM, and even they are higher than the category average of about 20%. Ditto for consumer discretionary. 17.3% of your portfolio is into consumer discretionary stocks versus the sector average of about 13.4%. What are the broader thoughts behind industrials and consumer discretionary stocks?
Sure. Consumer discretionary, when you think about the entire construct, there have been significant pain in the past few years with regard to various consumer name, including the consumer discretionary name. What is changing today is first the tax cut, the budget tax cut that should lead to, in our mind, higher discretionary spending in the coming months and quarters to come. Second is that the entire interest rate cut of 100 bips that should also start flowing through to higher discretionary spending simply because you'll be saving some pool of money in case you have, say, a housing loan or any other form of loan. And the third is the pay commission hike, which we're expecting next year. So a pay commission hike, typically for a 40 lakh government employees, it's a fairly sizable number that will see a significant increase in their salary. And some of those will preempt the buying by taking home loans or a personal loan or other forms of loan, which should also lead to better discretionary demand. So in that way, we think that discretionary companies are well placed to grow. There were some challenges specific to certain companies. Those have also been sorted specifically in our portfolio. And that is why we think it's fairly well poised to do well over the medium term. Moving on to capital goods or industrial names, again, a fairly well diversified names. You don't have any one specific pocket which is very heavy in the portfolio. For example, we have certain transmission and distribution names in our portfolio. And we think that the entire transmission and distribution theme is going to play out very well over the next 3, 5, and 10 years. Specifically, the next 3 years looks very, very promising, both in terms of order inflow outlook, the margin improvement outlook, and the return on capital outlook. And typically, in such scenarios, valuation moves up very, very sharply when we look at the historical context. You look at the cables and wires company, a very similar thing is happening over there, and we think that is going to continue at least for the next 3 to 4 years. There are certain other niche industrial companies in our portfolio, specifically with regard to, say, a bearing or with regard to industrial consumables, where the demand kind of keeps increasing every year for many, many years to come, given the size of the economy is growing. So a well-diversified industrial portfolio gives us that confidence that we are in the right place. We'll just need to be patient in some of these names, and hopefully these will do better over the next few years to come.
Okay. Let me just share the names from the small cap portfolio, the consumer discretionary stocks that are there in the portfolio. Amongst the top 10 are Garware Technical, Sansera Engineering, which has a PE of about 40.6. Garware Technical, of course, is a multi-bagger. They make the plastic that goes into fishing nets. This is 38.8 in terms of price to earnings, and about 2.32% of the portfolio of Kotak Small Cap Fund is into Garware Technicals. The other names are Amber Enterprises from the EMS space. 1.82% of the portfolio is into Amber Enterprises, and of course you have consumer discretionary also being represented by V-Mart Retail, about 1.7% of portfolio. In terms of industrials, the top pick is Techno Electric Engineering, as also one more stock which is in the top 15, which is V-Guard. So that's the broad structure of the top 20 stocks that Harish has in the Kotak Small Cap portfolio. Once you look at the overall AUM, which is somewhere like 17,330, about 5% is held in cash. Harish, is this something which is natural for you in terms of cash holdings of about 5% of AUM, or is this a safety net, maybe something that you want to keep your powder dry for an eventual downturn in the market?
Sure. So we typically we do not take cash calls, and the reason is very simple that we are always looking to invest in ideas which will do well over the next 3 to 4 years. So if an opportunity comes our way today, we'll certainly invest versus thinking about the absolute cash levels. And that also makes the entire portfolio healthy, because if the cash overall cash proportion is lower, you keep thinking about the existing names in the portfolio, and some of the names you can churn to a better idea. So there's always an opportunity cost involved. So fairly simple. Don't take cash calls. Keep looking at individual ideas. As long as the 3 to 5 years framework fit, keep investing in specific names in the portfolio.
Okay. Harish, I failed to see a PSU stock in your portfolio, and of course, no banks, whether private or public. Could you explain your distaste for the PSU basket? I understand that's value, but as a small cap fund manager, you're looking at growth.
Sure. So we have a couple of private sector names, and we have introduced a couple of private sector names recently, which you'll see in the June fact sheet, which is out by now. So we clearly have introduced some of the names in the portfolio. So there's no particular dislike or disliking for any particular area or any particular category. Our framework is fairly simple, that any idea which is entering the portfolio should be able to generate a fairly reasonable return over the next 3 to 5 years. So as long as that framework fits, we are fine. Some of the specific PSU names or certain names which have concentration in certain pockets, like say MFI or certain other personal loan category or a lab category, somewhere we get very worried when we look at how things have shaped up over the past few years. And are we looking at an imminent credit cost cycle? Maybe not imminent, but it could crop up in the next 3 to 5 years. So that is where we get very cautious when we are buying anything. We have to be doubly, triply sure whenever you're buying a financial company, because the upside to our mind from here on is limited, but the downside in case of a credit cycle increase is going to be significant.
And perhaps that's the reason why only 5.2% of AUM is into financials versus the sector average of about 19%. I think this is one area where you are super underweight.
There's another reason over there. There are a lot of capital market names which get classified under the BFSI category. Now, the capital market names have seen the best of the world, especially in the last few months. They have seen a significant momentum. And to chase companies which are seeing significant earnings momentum but are deep cyclical in our understanding, we haven't, in the last 5 to 6 years, we haven't seen a scenario of a sideways market or a down market for a prolonged period of, say, a 6 to 12 months. We would like to see the behavior of some of these capital market companies in sideways market or in a slightly down market. So one needs to look at how investors behave. To my mind, a lot of the momentum investors have got into these companies simply because near-term earning momentum is very, very good. It could play on the opposite side too in the coming years. So when you are building a portfolio and when you are thinking about returns, you also have to be cautious and start thinking about how the portfolio can behave in a sideways or in a down market. And which is why we have been cautious. The last 3 months on the market movement and the capital market names movement have taken everyone, including us, by surprise. But we stand firm with our view that let's just look at some of these over the longer term and then take a broader call on what's the right valuation for some of these companies, which look very, very elevated to my mind at this point in
time. Sometimes do you miss the absence of any defense counter, any capital market stock in this portfolio?
Defense, we have a couple of names. Defense, we have solar industries where there's a significantly growing defense business.
Of course.
We have BEML, which is again, there's some portion
Yes.
of that which is into the traditional businesses like mining and railways, but it's also moving significantly on the defense space. So we have captured some part of that proxy well in certain specific names. Clearly, the mandate over here is to look at the smaller cap names versus the larger caps, which have done phenomenally well in the defense space, like a Bell and a HAL. So our focus is that if we have some of these names, it gives us reasonable ability to play this particular sector without buying certain other smaller names where the probability of sharp earning miss is higher in our understanding.
Okay. Do you fear any kind of government action on private hospitals in terms of rising costs? Healthcare is the second biggest segment in your portfolio at the small cap fund, and we've seen the government sending all sorts of smoke signals for private hospitals to curtail costs. But given the quarterly earnings, each quarter the average revenue per operating bed keeps on rising. Do you think the government might take some action against these private hospitals, which might impact your NAV as well?
Sure. First of all, the way people have been looking at this sector, to our understanding, is wrong. People look at the headline number of the average RPOB, which have been increasing, which you also mentioned, that's increased significantly. But it's not only simply because they have been inflating their prices every quarter or every year. It is also because the case mix in a particular hospital has also improved significantly over the last 5 years. Case mix, to give you an example, say oncology. That particular was, say, a negligible proportion in a particular hospital, that is increased substantially to 15-20% in a particular hospital. Now, on average, the RPOB in oncology case mix will be significantly higher versus doing something which is, say, orthopedic, all else being equal, right? So people don't understand and haven't gone deeper into this. And even government could come out with some knee-jerk reaction. But when companies present their data, and data is something that we get every quarter, and we look at how things have panned out, there's no reason why we think that any significant impact will come in the medium term. There will be some knee-jerk reaction for sure. And people don't understand that the cost of running a government hospital, the absolute cost of running a government hospital, is significantly higher versus the cost of running a private hospital today. So government clearly wants to take a backseat in our understanding and let the private sector run with the objective that not only you make money, but you also grow your overall portfolio and bed size so as to ensure that you can cover a large section of the society. And that is what we are doing at this point in time.
Okay, Harish, what a lovely conversation spanning valuation, spanning stock picking, and of course getting a deep insight into healthcare as well as banking. My final question to you, at this point of time, do you think markets are fully valued? How does the second half look to you in relation with the stunning rally that we've seen in the first half? Any ballpark idea that you have on the Nifty by December 2025?
Sure. So valuation construct has to be thought through in terms of the number of years you want to be invested in the market. If you want to invest in the market for the next 3 to 6 months, it's very, very expensive. So please pull out your money. If you are invested in the market for the next 5 to 10 years, then the absolute valuation has to be thought through in the construct of growth and return on capital for the country, and which we can discuss in details that the growth and the return on capital construct for our country is very good and will keep improving. At least the growth construct will keep improving over the next few years to come. And with that, one needs to think more bottom up, needs to keep looking for ideas. And as long as we can do that consistently, we'll be fine and we'll make money for our investors. And that is where our focus is, instead of worrying too much about some of these near-term headline PE numbers, which does not give you the true picture in our understanding. Certainly, valuations have moved up, and it's the nature of the market that market goes up and market goes down, and market is volatile. So that's not a problem, that's not a bug, but that's a feature of the market. and that feature of market will continue. We might see a knee-jerk reaction, some 10, 15%, 20% correction tomorrow, and one should be prepared for that as investors, and we are as fund managers are prepared for that when we are building our portfolio.
Okay, and a final view on this tussle between Jane Street and SEBI. What is the peer group of fund managers thinking? Here is someone who manipulates the index, buys call options, sells puts, and makes more money as profit compared with the total AUM of a particular fund. What is the fund manager community thinking on the evening whenever you guys meet?
No, the view is very simple that as long as SEBI has decided on something, they would have done a fairly detailed work. As we can see, a very detailed paper came out. And as long as they have done a detailed work and taken a call, it should highly likely be right. It's subjected to, obviously, a lot of people will have different viewpoints over here. But from a firm standpoint, whatever SEBI does is right for the market.
Wonderful. With that, Harish, we'll call it a day. All the best for the next half and many, many years of continued very strong outperformance on the CAGR number. And here's wishing you best with all the stock picking as well. Thank you.
Thank you so much. Thank you. Thank you.
That, ladies and gentlemen, was Mr. Harish Bihani, Senior Fund Manager at Kotak Mahindra Asset Management Company. He manages 3 funds, out of which one was discussed in great detail, Kotak Small Cap Fund. I hope you enjoyed the conversation as much as I did. Thank you for watching. I'll be back at 2 p.m.